Perfect. All right, I think I'm ready. So we'll edit right up to this point and do the start. Well, welcome to another Saturday meetup for the Asymmetric Advisor. It is Saturday, April 17th, 1 o'clock in the afternoon. And I think this is number 32, the 32nd Saturday meeting. For those who are new to the service, and I may rebroadcast this, so those who are unfamiliar with the service, we do a Saturday meeting every Saturday, unless something really bad happens, like coronavirus. I didn't do Saturday meetings while I had coronavirus. And we'll do a couple of different things. Usually we'll review the trades that we had the previous week, and we'll also talk about different strategies. This one today is going to be an overview of what this whole service is about. And I hope it's instructional, both. And by the way, I have 3 different services, and everybody from all 3 services are invited to this Saturday meeting. So I try to do it in such a way that it will cover all the bases, because the services are different. There's an investment service and then two short-term trading services, 3D options and 0 DTE. So you wonder, well, how can you make one meeting that can cover everything? Well, I do. And in fact, that's what this meeting is about. Today's meeting is about how to create asymmetric returns, whether it is for investments, short-term trading of stocks, or invoking the 0 DTE strategy, the 0 days to expiration for an index like the S&P or the NASDAQ. And that's what we're going to do today. We're going to cover the overall general strategy of how we do that. And I started a little presentation for you, and I will get that going here. There we go. Asymmetric returns. And here's my general, really high level view of what an asymmetric return is. That's when the outcomes of trades have more profit than risk. Or I should say the potential outcome of a trade will have significantly more profit than the risk that you're taking on. Now, that would be a wonderful thing if we could do that with everything in life, right? Make all of our returns asymmetric, where we could just take all kinds of risks and they're very small, and then the upside could be very large. In practice, it is a very difficult thing to achieve because, well, it requires that you know your edge, that you know the environment, and that you have a solid strategy and methodology that all work. And also, once you're in the trade, once you've set it up in that way, you need to be able to manage it. But that's what we focus on here. That's the only thing that I do, and hence that's the name of the service, Asymmetric Advisor. We are always looking for ways of putting on very little risk and making the maximum profit that we can make. Now, the funny thing about this is that you can't always on every trade make that asymmetric return, the full-fledged 10x profit on your risk. However, if you structure it correctly, you can do it in such a way that even when you lose, it's so super small that it will be of no consequence. And those times where you don't necessarily reach the asymmetric profit potential, you can reach some potential that is at least as big as your risk or even bigger. And if you can do that enough times, that in of itself would be a great trading strategy. And then every once in a while, if you can create that huge return, that big kahuna return, then it makes up for everything. So in that, that is really the idea here. And of course, you want to lose as few times as you possibly can. And that really comes down to your methodology that you use. How do you set up the trade? What is your edge in getting into that trade? And then how can you set yourself up so that you consistently create those small profits, which are usually at least and we're shooting for about 100% of the risk, which by all objective standards in any trading strategy would just be mind-blowing returns. And for us, that's like our minimal return, but we try to do that consistently. And then every once in a while set us up so that we have, or that the asymmetric return, that 10x return, is available. So, okay, so I think I've explained that to death here. Let's get on to the next slide here. So what is an asymmetric return? Kind of said this already. An asymmetric return, a return, that's double the returns, is a risk reward profile with a positive asymmetry between profit and loss. That is more profit than loss. Of course, I said that in many different ways. Now, for us, we have asymmetric investment and trading strategies, right? So there's no one way to get there, and there's no one style to get there. For our services, I try to cover two basic strategies: investing long-term, and then trading short-term. And that is a strategy where the objective is to earn more when your trade or investment goes in a positive direction. In other words, in the direction that we want it to go, and less when it does not. In other words, we lose less when it does not go our way. So that's really the basic. That's what we're after. That's the objective. So first, I'm going to talk about the asymmetric investing strategy, and then we'll talk about the asymmetric trading strategy. And even if you're not in the asymmetric advisory, which is our newsletter, I think that you'll find this interesting, and you may want to join this if you find this sort of thing compelling. And I think you will, considering that since this was the actual original service that I opened a little over a year ago. And since then, the returns that we've got on the picks have averaged well over 350%, almost 400% on average. So some of them don't make that much. Some of them make much more. We've only had one trade, I believe, where we've actually had to get rid of it, but even that made money. And we do have one, I think we have one trade that might be underwater, or flat. But the long-term prospects for that are very good. This isn't a trading strategy. In other words, we're not looking for short-term returns. We're looking for long-term returns. And it's remarkable that we've had such huge returns in such a short period of time, because normally we're looking 6 months, a year, sometimes 2 years out. So far the service is going well. But in any event, we invest in markets or sectors that have, now this strategy is how we actually achieve asymmetric returns. So this whole thing is about a how-to. We do it in sectors that have natural and easy identifiable boom and bust cycles. And that is really important. So in other words, we want huge range in the lows and the highs of this particular market. And they should go through cycles that are regular, so that we can very easily tell, hey, are we in a bust cycle or are we in a boom cycle? Because obviously it will make a difference on how we actually approach our trade. And sometimes it may make a difference whether we trade at all. Again, these are long-term things. For the most part, we would like to be in a bust cycle when we actually invoke the trade. We'd like to be in a boom cycle when we kind of realize our maximum gains. Now, natural resources is just such a market. For example, mining, precious metals, and rare earth minerals, they're all part of the sectors within there. And we do have other markets that we look at. Well, actually one market so far besides these. Well, actually two. There's energy, and that might even encompass two different things, both rare earth metals and also other commodities like oil. But uranium is what I'm really talking about. And we do have one play that's in the oil infrastructure sector too, which hasn't really given us asymmetric returns yet, although it's returned, I think, well over 40, maybe 50%. What was really compelling about this particular stock was the dividend, just huge dividend, and backed by just a major company. But again, that's part of it, because we look at that long term, and that would be through the process of compounding with such a huge dividend. A 16% dividend would give us asymmetric returns. Anyways, I'm running on here. Second bullet is we identify the successful players in these markets. Now, this is all part of our methodology and strategy. How do we find these plays that that could blow up, that could be huge? And we start by looking at the people, right, that have demonstrated repeatable results with consistent, abnormal, positive returns. We want winners. We follow winners. That's the crux of our strategy, really. But there's more to it. We identify projects and organizations, explorations, new production, new capital formation, new companies, IPOs, mergers and acquisitions. All of these are the things that we're looking for, that are initiated or joined by these big players. And then we have two different types of trades that we make. We have speculative trades and or initial investments in these projects or organizations. So we look at speculative trades differently than investments, based basically by the amount of capital that we're willing to allocate. So speculative trades, we allocate less, and investments, we can allocate more. That's really based on our confidence in that particular play, right? We hope that all our speculative trades turn into investments. Now, we manage these trades to full positions, taking profits at predetermined times for reinvestment, including dividends. So in other words, what we do is we look at any trade, any speculative trade or investment, and we don't go all in. We usually go in something we call tranches, which means part of a whole, where we have a full position that we could realize, let's say it's 10. But what we do is we'll break that 10x position up into 3 to 5 tranches, let's say 5. So each one is 2, right? If it were 5. So we put 2 positions on, then we put 2 positions on, then 2, until we get to 10. That would be our full position, which would never be more than, say, 10% as an investment. And we do that because we don't always know whether or not we're getting the exact right price, or it could be doing fantastic and we want to add on to it until we get to a full position. And the same thing with speculative. We might maybe do three tranches on that, only because of the volatility of that. So that's what I'm talking about, how we manage our trades. All right, next slide. Here's our asymmetric trading strategy, which is wholly different than investing. This is all short term. We're not looking for long-term gains. We're looking for short, consistent profits from a day to a couple of weeks. And we use option strategies as the principal mechanism to create asymmetric returns. So in other words, we use the power of being able to model our ideas with option strategies in such a way that they allow us to define our risk and also define our potential profit, whether it's a defined profit or even unlimited profit. But most importantly, we try to define the risk so it's very, very small compared to the amount of profit that we can make. And we want to do that in a consistent manner. And we want to be at a point where we put a trade on and we're totally comfortable with that trade. That if it goes to zero, if it's a total loser, it will be like nothing to us because the size of that position is so ridiculously small. And because we understand that if we put on enough of these positions and we have a high enough win rate, that in this case, in our strategies, at least in our 3D option service, and also in the zero DTE, where we win about 70% of those small ones, where we make maybe not the asymmetric return, the 10x return, but we're making 1x or 1 times our risk. So in other words, 100% of our risk is what we are normally making in those trades. And And then with the potential of making 400, 500, or 1,000% of that risk that we take. And so, so far, our win rate. Now, occasionally, and we have put on some in the 3D space because it's a little bit more difficult to put on these asymmetric trades. We have had a couple of max losses that weren't asymmetric trades, and that was earlier on in the service, and so we're switching away from that and looking at a different way of trading, something that is more akin to the way we do our 0 DTE. But in any event, we try to find companies or assets that have excellent liquidity and beta being the amount of volatility it has relative to the market that it contains it. So in most of these, they're in the S&P. And so we want to have, a beta of 1 would equal the same volatility as the S&P has. Something over 1 would mean that it fluctuates even more than the S&P. And that's what we want. We want that fluctuating pricing. We want that volatility, because the volatility is a key component to allow this strategy to work. So consequently, when we have very little volatility or when it's dropping, it makes it more difficult, and we have to employ different types of strategies and perhaps employ them less often, waiting for that opportunity to arise. Low volatility is really a problem with virtually all traders, but there are strategies that we have that can still have asymmetric returns even in low volatility situations. We choose time frames that are relatively predictable. For stocks, this is usually around 3 days to 2 weeks. For indexes, it's about 1 to 2 days. Most of our index plays are just 1 day or the last day of expiration. And primarily, but not exclusively, we are net sellers of premium. So we find that there is an edge in being a net seller of premium. And that really depends on where we are in the life cycle of the market, right? About 85% of the time, we have a definitive edge being a net seller of premium. About 15% of the time, we don't. So we try to identify those areas, and that's when we might switch up our strategy. And we also use volatility and probability of touch as one of the principal ways that we have to be able to create consistent returns, even though we're not always trying to strive for that 10x return. So we'll set up a strategy in such a way that the 10x return is possible if there's enough movement in the underlying asset. But if it doesn't move all that way, we would still want the opportunity to make profit. And so we're relying on that volatility to give us that ability to at least move close enough to the 10x return that there's still value in that trade. And by doing that, we can make upwards of 100, 150, 200% of the risk that we put on. And we can do that consistently. And this is part of our secret sauce, this next bullet. We use volume profile and linear regression to create probabilistic scenarios. And if you go back to my YouTube channel, you'll see that I have a lot of videos on volume profile and how I believe it is really, in my view, the best way of being able to analyze market structure and be able to accurately predict the behavior of the market by coming up with these different scenarios that are possible. All right. Next bullet, next slide. Risk management. Of course, risk management is important. Now, with investing, we, and I talked about this a little bit before, we allocate our capital sparingly with the intent of growing speculative plays into investments. We focus on taking our initial investment out and then reinvesting it. Very important. And this is kind of, this is like compounding and using the money that we've made that makes at least 100% of our risk capital, taking it out, let the rest ride, and then taking what we take out and then reinvesting it again. With trading, we set up trades using options that have profiles where the risk is usually an order of magnitude smaller than the potential gain. Our goal is not to achieve the potential gain. well, ultimately that is our hope, but that's not what we're shooting for. We set up the trade in such a way that it could, based on the average true range and the amount of volatility, it has a very good chance of achieving that that maximum gain. But the reality is it only happens like maybe 1 out of 7 times. But when it does, it's 10 times the risk. So it's a huge gain. And it's one of the reasons why in this particular strategy, we could be losers 5, 6, 7 times in a row, and it's still not going to bother us. Although that very rarely, I don't think, well, it's never happened. I think we've been up to 2 or 3 losers in a row, but even that is small because we can come back in the next trade. Our goal is not to achieve the potential gain, but use probability of touch to achieve at least 100% return on the risk with an initial tranche and let the remainder ride. In both investing and trading strategies, initial positions are never more than 5% of our available capital. And that's for speculative trades, speculation or trades, 10% for investments. So investments, that implies that we never really have much more than, 10 major things in play. Of course, if we had 10 major plays, then we wouldn't have anything for speculation. So most of the time we have, 5 or 6 investments in play, and then the rest of the money is used for speculation or trading. And we split positions up into tranches. I mentioned this earlier. With investing, that can be up to 5, and for trading, usually 3. So this gives us the ability to be able to manage our risk by not committing everything right up front, and then adding if we can reduce our cost basis, or it makes sense because maybe the darn position is on a run and we want to capture that run, or it just looks like it's just a runaway success and we want to, get our money in there. So that's one of the reasons why we always start with our initial tranche. All right. Our investment methodology. Now this is the investing side. This is not the trading. What is it that we do to generate these types of returns? And this is really important. First of all, it takes an extreme amount of research. Finding these companies that go from little fledglings to potentially, NASDAQ behemoths isn't easy. And it's hard. Sometimes you miss them. Sometimes you get them. Finding others that grow up and maybe go 5, 10, 20 times their initial value is a little less hard, but there's a lot of those out there and significant companies. What it really takes is incredible amount of research and a lot of research items, I guess. And that's what this next one is. I personally subscribe, or through one of my clients who provides me with this access, high price newsletters, like newsletters literally from billionaires. And we get to talk to those billionaires because of the price. For instance, there's one particular newsletter that we subscribe to that this is crazy, but it costs $5,000 a month, but it provides us about an hour's worth of access to this billionaire every quarter, and we can call them up and have a meeting and ask them anything that we want. So I think that money's worth it. It also includes, and that's not the only newsletter. We have tons of different newsletters and investment research sites and things like that we subscribe to. In fact, my client spends about $80,000 to $100,000 a year. Plus, he sends me to conferences and that sort of thing. We belong to mastermind groups. I also subscribe to my own stuff too. My client, when I say my client, I'm the CIO of this family office fund. And an intense and concentrated data gathering method. So I've developed my own sort of methodology and organization of how we get all this information and make sense of it. And we have a very specific analytical model that we follow in these types of investments. And the first thing is, and what I said before, was the people, finding the winners in the industry. And really that's what most of this revolves around, finding the people who have the Midas touch and basically follow everything that they do. And any other project that they spin off is usually a good bet. We look at their projects, we look at the finances, do a entire makeup of the financial model of the company. If they are promoting say a mining project or a production or an exploration tremendously, if somebody is out there putting a tremendous amount of capital into promoting it, then they probably have something or know something that is something that we're very interested in. And so we monitor that amount of promotion that they do. We're looking for catalysts in the industry, things that could set something off, or things that set something off and now maybe we're negative, and now that thing is removed, now it's positive. A good example of that would be the coronavirus pandemic last year. It basically shut down all mining, and that created opportunities other places, but certainly made some of those, well, it basically shut down mergers and acquisitions. And then finally, we look at price. We're looking to get the best value for anything that we get in. We are extremely patient and looking for the best possible price. I mentioned things in the advisory service, and people want to get into it. They go, when do I get into it, Ernie? And I set these super low prices, and they're saying, how can that possibly happen? But it does, because these are extremely volatile markets. We're looking for these boom and bust cycles, and we're going to be patient enough waiting for something to come down to our price so that we can get the best possible price, so that we can get the best possible return. And that's what this last bullet is. Above all, we're waiting for opportunities to deploy capital. The best of the best is financial or market disasters. We love those. So like if there's a crash in the market, like there was back in March of 2020, that was pretty much the best time to invest in gold miners, exploratories, royalties, and streaming companies, and that sort of thing. And as I said, patience is the key, waiting for the right price and the opportunity, and then strike. All right, next, we're going to go on to the swing trading methodology. Hopefully you're finding this interesting. I'm kind of like bearing all on what we're doing here, right? So to start off, the swing trading methodology, we're trading stocks, highly liquid stocks. We develop a short list of candidates, about 20, based on specific criteria such as liquidity, beta, and value. We're constantly pruning and developing this list using a life cycle methodology. So I have a much larger list that are in this kind of stasis that we're looking at. And then there's the list that we choose of the stocks that we trade, and that's a much smaller list. But we're constantly pruning this list and testing. Other things might come in. Market conditions may change. So for instance, we might go from a good market to a bad market. When you go to a bad market, you might gravitate more towards consumer staples. You go to a good market, you might gravitate more towards technology. We sort the list each day by implied volatility, and we concentrate on the top members of that list, but we don't neglect the other opportunities because there might be something else in there. We analyze the volume profile and develop and realize a market structure and a potential medium and long-term scenarios. In other words, the market profile provides us with where we think value is and where value isn't. Also, it provides us some behavioral analysis about, as price moves across that structure, where it's likely to go. And from there, we can develop a probabilistic set of scenarios. And then from that, we can determine what kind of capital or strategies to employ. We identify big chart patterns in these stocks that have statistical significance as defined by Bulkowski. Bulkowski has set the standard for doing research on chart patterns, candlestick patterns, and other things that, and by looking at literally millions and millions of charts and then being able to distill that down to actual statistical information. So now we don't look at all the patterns. We don't care about all the patterns. We only care about the 10% of patterns that are the best of the best. And so we can apply those. And what we're always looking for is that, one of these stocks that we're interested in, is it at an inflection point in that pattern? In other words, is it hitting a point where there could be a breakout or a reversal or whatever, and those are the points, those are the places where we want to place our trades. The other thing that we do constantly is where we want to become familiar with all the binary events that could possibly influence that underlying stock. What's a binary event? A binary event are events that happen, at a specific time, and they're like one time, or they could be repeated, but I mean, they're happening, that day. Things like earnings, product announcements, even things that are external to that specific stock that might happen in the market, that might be, global macro issues, things with economic reports, that sort of thing. And then we select option strategies that model the structure that we create in the volume profile. And we place them in such a way that we're expecting price to move into our asymmetric return. So that's basically how we do it. All right. So in the very last slide is our 0 DTE strategy. Our 0 DTE strategy has a lot in common with the 3D strategy, except for that we're only looking at really one thing, and that's the S&P and derivatives on the S&P, either the S&P index or the E-mini futures. The reason for that is that they trade 3 times a week. Instead of having, like most stocks have, weekly or monthly expirations on their options contracts, these have expirations on Monday, Wednesday, and Friday, giving us a lot more opportunities. But in particular, we're looking for that very last day of expiration, which is Monday, Wednesday, and Friday, because, well, I'll get to that in a second. The other thing that we do is we identify, just like the 3D options, all the binary events that could influence it, including economic reports and global macro condition, because that could move. What we're really looking for is movement for that day. If we can get something moving on that day, or not moving that day, then there's a good opportunity to put on an asymmetric trade. We, in the big picture, you want to identify major trends and direction, and basically go with the trend. Analyze potential price reversals, looking at the market profile and how that, or the volume profile, and how that might identify objective support and resistance levels, etc. So we're interested if something's trending or if something's in a channel, and is it a pullback on a trend, or is it a reversal on a channel? Things like that. Does it comply with the market profile? Are those legitimate support and resistance levels? Does the behavior as we apply to market profile and the market structure comport to that? Can we model that in a option strategy and overlay that in such a way that if it does move where we think it's going to move, can we achieve an asymmetric return? And if we don't, can we at least achieve 100 to 200% of the risk that we take on, based on the amount of volatility and the amount of movement? And should we, through a probability of touch, be able to achieve that that kind of return? And then I guess I just said this, that we adjust our option strategies from, well, I didn't say this, but we're not always looking for a, although I may have said this in a previous slide, where I said that we want to be net sellers of premium. But you can't do that all the time. There is an inherent edge in being a net seller of premium, but that edge is only about 84, 85% of the time. The other times there's no edge at all there. So being a seller of options isn't always the best way. Sometimes you need to be a buyer of options, whether it's like just buying a long call or a long put. So we adjust based on that, and also based on volatility and the true range that that exists over the past week or so. And then we set our strikes and create asymmetric returns should the full range be realized, and normal returns via probability touch, which I've been repeating a little bit, over and over again. That is so important. Probability of touch and the amount of volatility that's in a market is what really gives us our consistent returns. And playing the potential of where something can go with the asymmetric returns is really the sweetness part. Every once in a while you get a big return, a really big return, but most of the time you have a darn good return, and every once in a while you have a loss that can be palatable. All right, that is my that is it. Let's see, go back to the big head. That, my friends, is everything. That is the three services: the investing, the trading, which includes both short terms with stocks, and the super short term with the 0 DTE strategy with the index. And by the way, it can be both the S&P or the NASDAQ index, although we haven't done much with the NASDAQ yet. I'd like to do that, but it's more expensive and it's much more volatile. So we haven't really touched that quite yet. But now the volatility has basically gone away in the market. Maybe it will be time to go to the NASDAQ where we might find some real volatility. All right. So that's the entire presentation. Hopefully this makes sense to everybody. Sorry for those that just came on and missed out, but it will be recorded and then archived in the website, like all of our other Saturday meetings. Does anybody have any questions, comments, ideas that you want to share? No? Always a quiet crowd. All right. Oh, wait a minute. I can't hear you. Peter, your mic is on, but there's no volume. Let me see. Hold on. Yeah, no volume. Maybe you can type in your question. Oh, wait, I hear something.
Can you hear me now?
I can.
Okay. Ernie, I noticed on Friday that we used a butterfly spread.
Yes.
I've traded a lot of butterflies. And because I got out early, it worked for me. I'm just wondering, when we place these 0 DTE trades, how successful you think just putting on a butterfly in either direction would work, because the market hardly moved and we got profits.
Okay, so the butterfly, the reason why it works so well, and you're usually expecting it to work very quickly because it has such a great amount of potential profit versus the risk, or there's a lot of premium. And so if you're in that particular time frame and you got a huge amount of premium as opposed to a small amount of premium, then obviously more from a strict dollar amount is going to be decaying, right? I usually place them in such a way that the apex of that butterfly or a similar strategy, even an iron fly, is within the range of the average true range of the asset. Now, one thing that's been happening with the S&P over the past several days, several weeks, is that the average true range has been declining rapidly. Now, I didn't realize how much it would decline on Friday, because it really took a real nosedive. Even then, it went from like an average range of about 25 down to like 16, or an average range of 30 or 40 down to 16. It was nothing. So I placed that based on about a 20-25 point range, the apex away from where the market started, or and the further I can place it away from where the market currently is, the better I can get an asymmetric trade out of it. The smaller the risk and the higher the reward, or the ratio will be more asymmetric. And so I'm relying on that range and that probability of touch. Now, it doesn't have to end up in the middle of that butterfly to profit. It can just approach it. And that's, I think, what happened with you, Peter. It approached it, and you got close enough where the slope of the T0 line was such that you were able to still make a profit and then get out. And that's one of the beauties of it, that as long as you have that volatility, you can still win through that probability of touch. Market's moving like this, and it gets up there, but it's still not near the profit tent, but it still has value, so you can get out and make a profit. Usually what happens is that we have enough volatility that we can quickly get inside of that profit tent, and then the amount of increase, or the rate of increase of premium decay, is even much greater. And we don't have to spend much time in the trade. Yet Friday's trade was not like that, because volatility had shrunk down to nothing. It did eventually get inside of that the profit tent, but not until the end of the day. So uncharacteristically, we held that from, I think, around 11 o'clock all the way until the end of the day. And it finally did get inside of that profit tent and was able to make some halfway decent profit. So that was really what happened. I noticed that you said that you got out very early, so you at least got that first initial surge, and then it just took forever to inch its way back up there. And I think you even made the comment that had you stayed in, that you would have done better, because it eventually did make it all the way up there. And then of course, right after the market, right at the end of the market, it just dropped off dramatically. Is that a fair recount of what happened?
Yes, indeed. That's
Yeah.
exactly right. Now, the thing is, Ernie, my question is this. That did move. It moved very quickly. What is the downside of when you think the market is going down? Just putting on because, for instance, when the market moved up and I got out of my position, I got a signal that the market was going to move back down. Mm-hmm. At that point, I looked at a put calendar. I didn't take it. I looked at a put calendar, and it was trading the same structure that we put on for the call calendar. On the put side, was trading at 1.5 points. So for $150, I could have put that on, and that subsequently went to 6, and then bounced back up. It just that little move down, and I was thinking, wow, maybe the most asymmetrical type strategy for this, when you think it's going up or down, is that butterfly.
It is.
Okay.
It is.
All right.
And yeah, I agree.
Okay. So I just wanted to make sure I'm seeing that correctly.
Yeah. And that's one of the reasons why I'm moving more towards the butterfly, because it affords more opportunity. Yeah. There are times though, where I can put on, let's not talk about the SPX now. If we talked about the E-mini, for instance, there might be a significant event that happens in the Globex session overnight, and the best way to take advantage of that is to put on a long call or a long put, and then just let it just ride the whole day.
Right.
And you can make significant profits that way. So it really depends on the situation, but mostly, obviously the US market is the most volatile, and you're expecting the volatility and you're expecting that movement. But then when it doesn't come, it makes it tough. And like I said, the further I can place the strategy away from where we enter the trade, the more we get that asymmetric relationship. That's probably one of the most important parts. And you can also do that with spreads too, but they're a little bit more difficult to achieve profitability. But being able to get that huge difference between the amount of risk and the amount of risk that I want to put on, generally, I'm trying to capture something like anywhere from 50 cents to $1.50, or $50 to $150 of risk. And then I want the potential profit to be about 8 to 12 times more than that. And the reason for that is that then that creates a profitability curve, what they call the T0 line, right? That extends, and if price starts moving towards the profit tent, even though we're outside of it, you can still make substantial profit, right? I mean, you could easily make 100% to 200% of the risk that you're taking on.
It does seem, however, that in order to do that, in order to actually capture that a huge profit, you have to trade multiple contracts. So you have to get out of some and leave others. Otherwise, as happened on Friday, I mean, that when I got out for a minimal profit, a decent profit, when I got out, within, I think, 20 minutes, the market went back to where I would have made nothing.
Right. So yeah, there's you can look at a different allocation strategy. So for instance, maybe you start with 2 or 3 contracts, right? And then when you make enough money on say the first 2, you take those profits and let that finance your third contract.
Yeah. I got it. But it just seems that the only way to actually get the huge profit is to either, if you're trading one, give up the potential for a 100% return, and instead go for the big one, or trade multiple contracts.
Right. Well, or just have the balls to stay in, and but that's kind of, it's probably not the best strategy, considering that it only about, the way I have it configured, or the way I pick the trades, only about 1 in every 7 shots do we enter into the deep part of those the profit tent. Most of the time we're going to be able to pick off a 1x to 2x profit, which isn't bad, by the way. I mean, you could make a living off of just getting 100% return on your risk.
Right. Right. If you could do it every time. Well, anyway, thank you. I don't want to dominate, but thank you for discussing that.
Oh, no problem. All right. Anybody else have any questions? All right. I'm going to end it there then. I want to thank everybody for showing up on their Saturday, and I hope you have a great rest of the weekend. The asymmetric trade actually potentially starts on Sunday evening, because that's when futures open at 6 p.m. Eastern time. And so I'll be looking at the market then. There's a possibility I could put on a trade. Although these days, the market just keeps on going up, and it did on Friday even. But and it hit all-time highs again. However, the I don't know if the range is going to continue to contract. Now, the interesting thing about range contracting is that eventually, well, I would say that consistently or historically, after range contracts for a little while, there's usually an explosive move, either up or down, usually down, could be up. Maybe that's because that's where the trend is, but there's usually an explosive move once, it has gotten to that small enough range that nobody can take any. It's sort of like the total absence of potential means that now there will be a, full potential, full potential move. But that's what I'm expecting at some point soon. All right. So I hope everybody enjoys their weekend. Thank you very much. And I will be recording or processing this and then archiving it on the website. So I'll send you an email notifying. Thank you very much. Take care.
Thanks, Ernie.
You're welcome.